Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhodes on the Buy Here Pay Here morning show. Take it away, you two.
Good morning from Oklahoma.
Good morning. Yeah.
Good to be back in the studio.
Yes.
Had a quick run to Texas. Had a friend go in the hospital after getting bucked off a horse.
Yeah.
Which that's the first time I think I've said that about a friend. But
he like breaks horses for a hobby.
Not like in a round corral like what you think about, but he works with young horses and he took a spill. It bucked him off and he busted up a bunch of ribs, and he's lucky to he's going to be walking away from it, but he's going to be very sore. So anyway, that kind of
know if any of you out there have ever had that happen to you. I haven't, but man.
So shout out to Tim. Get yourself better. He's going to have a slow recovery and a kind of he's going to be tender for a while. But anyway, we're back in studio. Just been kind of a abbreviated week here because of some of that travel, and so we're back here and kind of catching up.
We're getting ready we have a big meeting in Denver not this Sunday, but next Sunday.
Right.
It's going to be a big meeting.
I'll
sure. Hear more
Got
about
our
it
team coming together, and excited to have that done, and nice opportunity for us to kind of share what's happening and kind of give everybody a rundown.
In Denver as well, the opening of NIADA's annual convention, an expo, it starts on Sunday as well at the Gaylord by the airport.
Denver.
Yeah, it's a really nice resort out there. I do know that, you can still get tickets, but I believe the Gaylord is sold out.
Okay.
So if you're still thinking about coming to going to the conference, there are hotels in the area.
Of course. Tons of them out by the airport. So, maybe we'll see a few folks out there. That starts on Sunday evening with the reception, and then sessions are mostly Monday, wrapping up on Wednesday, I believe. So, all good. We can dive into our subject for the day. This is a big subject.
We kind of touched a little bit on it a couple of weeks ago when we talked about the news, the news that's affecting our industry.
Right.
And this was this is an expansion on a few of the points. And as we were kind of going through our talking points, Jim's like, man, we could just have an entire show just on the first talking point. So we'll try to, clip along so that y'all are not being overly inundated with our thoughts on all the things. But it's some important stuff. There's some really big things that are happening in the industry, federally, and for the subprime auto industry, we know that the cars rule was kind of suspended, and everyone thought that everything was going to be that's a cakewalk. Yeah. It's like, there's nothing to worry about. And we talked a couple of weeks ago about how the lens has shifted from one place to multiple other places.
Yeah. And I would invite, if you're a typical, mom and pop dealer, I would say hang in here on this subject because at first read, you might think, well, this doesn't really apply to me. This is kind of, and there are pieces in here that you can say, this definitely doesn't apply to me, but if you stay with us, you'll hear how it connects the threads to this is really how it probably affects your operation like next week. Okay?
Absolutely.
Okay?
Absolutely.
So let's dive in, shall we? So
first of all, Fed report deep dive.
Right. Yeah. So so what we've got, in fact, I'll just go ahead and share the link. I got it teed up here. So it'll hopefully when we share that, it'll go out to Facebook and LinkedIn for our folks who are tuned in there. The link to the actual article at the Fed Reserve. First of all, just a quick note aside, we're learning because we don't pay a lot of attention to politics, but and kind of even government structure for me.
We have friends that go like, how can you not?
Yeah.
It's like we pay attention to the news, what news Claude or ChatGPT wants to give us based on what we're looking for and what affects us.
Yeah. And if you see something big in social media, you go investigate and make sure you know what's going on. But otherwise, I find it, I don't miss the news at all. But anyway, this is the news I'm really referring to is it's not even news. It's more just kind of political structure or governmental structure, is that the Federal Reserve is not even really a part of the federal government. It's a private thing.
Those of you that pay attention, they know that
Yeah.
it was formed like in the 20s.
Yeah.
And it was, there's a big backstory. If you want to learn about how the Fed was created and what their overarching powers are.
Yeah.
Too.
So I think one of the first things that's mentioned in here that I'll just say now what's on my mind. The Federal Reserve is not your regulator. If you're a buy here, pay here dealer, it's not like the Federal Reserve is going to knock on your door and have a problem with anything you're doing. That's not what we're saying here. What we're saying is what the Federal Reserve was, they had put like 5 economists on the job of going to investigate the buy here, pay here to come back and report what is it, how is it different from the rest of the auto industry, and what should we know about it? And what triggered it was the Tricolor collapse, right? And so this is very much, so the reason you as a local mom and pop dealer don't have to be concerned in the same way is because you didn't just cost Chase $200 billion or whatever, the 200 million.
And you might have people out there that are saying the Tricolor story is old news. It's not. It's just, it's kind of like the catalyst that's shifting a lot of pieces, and they're continuing to shift.
Yeah, and there are going to be pieces that affect you. And I will say that as we ran this through Claude, and asking for updates, and it found this article and said, this is really relevant to your audience. It also, I will say, a lot of what it did is, in a contextual way that Claude and AI can work. It knows a lot about white hat way. And so a lot of what it fed back to us was kind of filtering through that lens, right? So I think that's part of why we want to, dig into this. I'll also say right off the top that most of the data, because they really leaned on data, these economists, and what they went to was Equifax. It says Equifax credit panel data. So let's stop right there for a minute.
Okay.
If everything we're about to talk about is coming from Equifax credit data, then what that says is it only represents this much of the buy here, pay here segment.
Those of you who are in the industry, those of you who are not in the industry, so just that many buy here, pay here dealers choose not to report to credit agencies.
Right.
They also choose not to do, there's a lot of them that choose not to even pull.
Do a credit pull, right.
So like Jim said, I don't know what the percentages of dealers that actually report credit.
I did a poll in Facebook. I didn't think to look it up, but it's on the low side. It's certainly less than half, and it's probably it's so I think
but it's still a representation of those that do report credit, and we don't notice a huge difference in business models or all of the other things with people that report credit and people that don't.
Right.
So,
Yeah. So I think the thing to remember, though, is irrespective of what data they used what data they had available. And they were able to identify in that data the difference between what we'll call subprime and deep subprime. Okay. Yeah. So they're going to put buy here, pay here generally in the deep subprime bucket, right?
Yeah.
So that there's some indication in their data that said, in the last 7 years, deep subprime is less and less of a percentage of the portfolio. Where it was around 70% in 2018, it's now down to just above 50%, according to their data pool, is in a deep subprime.
So can you define the difference between subprime and deep subprime?
Yeah, they're basically, the number was 540 credit score. So again, mathematically is how they're defining it.
It's based on your credit score.
Credit profile.
Okay. So 540, anything below that,
which is interesting to me,
is considered deep sub. I mean, we have our own conversations about how subjective all of that is anyway.
Yeah.
But so that's by the numbers.
Yeah.
By the data.
Yeah.
Anyone with under a 540 is been generally the main customer for buy here, pay here. And this article was showing that there's been a shift from that. So
I would guess that if 10 dealers are listening to our podcast this morning, only, let me say this right. 9 out of 10 of them don't even have credit score in the top 5 of the things that they would look at to make their decision, yes or no, and approving.
So yeah, the Federal Reserve is not looking at job time,
right?
Residency time.
That's right. That's right. They don't have that kind of data typically, at least not of the applicants that are buy here, pay here dealers.
It's a good thing to use.
It absolutely is. Yeah. And so we're not saying that to say that it's irrelevant. We're saying that when you see the conclusions that they're drawing, there are both positives and negatives. And again, I don't think that it means that anybody's going to be clamping down on you from a regulatory standpoint.
Yeah, because they don't have any really. The Fed doesn't have regulatory authority over buy here, pay here. But what it does is it affects our banking industry, our lending industry pays attention to this.
Right.
They pay close attention to this, and so that's a big place where we talk to dealers every day who are like, all right, I'm wanting to find new money,
right?
And there are plenty of not plenty. Banks are scrutinizing things differently, and understand too that a lot of the lenders within our space are funded by banks as well. But it's kind of that shadow money thing we talked about a while ago, where it's like, so even a lot of the people that lend money within our space are also affected by these kind of things, because their money a lot of times are coming from financial institutions, by big banks.
Sure. Yeah. I think, you obviously can jump to the conclusion that this is going to affect pricing for dealers who are shopping for capital. Could affect access. And there's a lot of things to talk about and think about there. But I think the key things from the findings, let's talk about what really happened. It sounds to me like what I understood from the thing, Michelle. If you read it differently, let me know. I think the Senate or Washington asked the Fed to investigate. The Fed put these economists on it. They did a report for the Fed, and they fed that back to Washington, Senate, House,
which is where
Congress.
Senator Warren, Elizabeth Warren was like, we need to do a deep dive.
Yeah, she was already investigating. They were already sending letters, and they're investigating. That was really about repo practices, kind of a carryover from COVID and the high repo rates. And so there's different things at play here. So the high repo rates were already happening before we got news about the Tricolor collapse and the whole fraud thing that happened over there. So that is, or alleged fraud, we should say. I guess it's still under investigation, but that's the part that I think we want to be watchful about. And I think as we see this, irrespective of that, you got two big banks, Fifth Third and Chase, I think, are the two banks that got hit to, big numbers.
Most everyone has heard of Chase.
Yeah.
Fifth Third is kind of, I didn't hear about until we went into the second.
I have been in the buy here, pay here business. They've been around. They have a pretty large footprint, and they're more active in the kind of the subprime sector, maybe. So, but they got stung to the tune of 100 million plus, with the Tricolor thing. So it's caused. I'm sure they reached out to the Fed and say, "Hey, help us! Let's figure out what's going on here." And I'm jumping around here in terms of material as these things occur to me, but we can go through it more methodically, Michelle. But I think the thing that occurred to me is, as they went through that, they learned that actually the buy here, pay here, the lenders who are loaning into buy here, pay here, actually were suffering less than traditional
previously.
And then traditional, because they had baked into their underwriting higher, numbers, whatever, lower advance rates, all the stuff. And so they were actually seeing less default outside the big collapse of the Tricolor thing. They were actually seeing less. So there are silver linings here. But I think what it also highlights is this thing about how buy here, pay here dealers approach the business. Okay. So what this really highlighted, and some of what it talked about, is we recognize it, and this is saying in a very specific federal study of 5 economists who were paid well to perform the study, I'm sure, they're saying what we've been saying from before. we recognize that this is a segment where the consumer is at a disadvantage.
Mm-hmm.
And they go on to say these dealers in the buy here, pay here segment are fulfilling an important high risk service.
Mm-hmm.
Okay.
Not a lot of people want to dip their toe in that.
And they went on to say they're charging a higher interest rate, which is justifiable because of the risk profile of the consumer they serve.
Yes.
All good news in terms of supporting our business model.
Mm-hmm.
The thing they went on to say, and this is the part where it gets a little bit subjective, I suppose you could say, is that the question really becomes, is if we know the customer's at a disadvantage, do we take advantage or do we create tools and solutions to help them be successful? So this is a really, kind of a long extrapolation from what the Fed really, their report, go in there and read it. We shared the link already. Go find the actual report at the Federal Reserve and you will see what I'm talking about. It is drawing that conclusion that, this doesn't say that, dealers aren't predatory. That's not what the report says. It says dealers are operating in these kind of margins. This is the customer they serve. This is the profile of the customer they serve. And it's really drawing that conclusion. And I think the what I would jump to based on what I'm seeing in the report is really in summary for me, it's like dealers who operate with integrity, higher degrees of transparency, and have solutions to support the customer are going to be the ones who will have the best access to capital going forward.
Well, and one of the things that was pointed out was those that are already doing that are better positioned to weather the storms. Not just to access capital, but they're better positioned to be able to weather the upcoming storms.
Right.
That are happening. And we're always coming across like some really interesting data from our work with V8 and things like that. And so it's interesting to see this report come out that we can like turn around both of them. And it's like, where are the overlaps? Where do things tie? And it's really a testament to things like transparency, things like, where all those 97 letters that went out were about untransparent sales practices.
Right.
And that should tell dealers an awful lot. It's like, are you being transparent with your customer up front, not during closing? Because that's, everyone can say, well, it's in the closing documents, which we've talked about this. How many of you read your closing document packets word for word before you sign them?
Right. Absolutely.
And those of us that have are fortunate enough to have better credit than 540. I mean, when's the last time with a car loan or a home loan that you don't read them? Say it's in the closing packets and, you might brush over it or, they do the synopsis stuff. This is about letting them know on the front end exactly all of the terms, all of the fees, all of the everything that you could be experiencing, that's a good thing. Really for sure.
Thing. Let me read one section from this. This is talking about loan characteristics that they identified through the Experian process. And again, this is representative of a sliver of prime versus subprime. So the average buy here, pay here subprime loan came in at 15,402.
That sounds about right from your,
And the payment was 405,
which is low,
and a 55-month term at 25.39%. So that the fact that they say a 55-month term at those interest rates, you're talking about this is the bigger operations. I almost never see 55 months in our V8 circle.
Not for buy here, pay here.
Right.
You might for a new car.
But this is calling it, they called it a buy here, pay here subprime loan. Okay. The average traditional subprime loan. So they're differentiating between a subprime and BHPH versus traditional. It says the average traditional subprime loan has a 17.4 balance with a lower payment of $350 a month, a 64-month term, longer term, lower payment, and a lower interest rate, 14.6% interest rate. Okay. So it says the BHPH customer is paying more per month on a smaller loan for a shorter term and at nearly double the interest rate. So what it says is that's a compressed affordability window.
Okay, explain to me what you understand about that.
So what it's basically saying is it is compressing the note, making the customer pay more. So if the two customers have the same income, the affordability factor is harder. It's harder on this buy here, pay here customer, right?
Okay.
That's basically the conclusion that one would draw, because you're asking the customer to pay a higher payment on it's a higher interest rate, shorter term, which, we can get inside the math of all the one day and look at all that. But I think the key point here is that it is harder for the customer to afford. Okay.
For a buy here, pay here subprime loan. And it would be interesting to find out, like, there's an average buy here, pay here subprime loan and an average traditional subprime loan, and where those credit scores shift from one to the other, because I don't know if we were to look at let's say the local Chevrolet used car section and they're doing a subprime loan, what are their qualifications to sign off on that, and what are their charge off rates? Because what we see with the big guys is they flow in and out of this sector, don't they?
Who do you mean by the big guys? The capital?
The dealerships.
I think they're in it. Their underwriting may adjust, and how deeply they write paper and their volume may adjust, based on the barometer of the industry or whatever, and the economy. But I think the typical, mom and pop Main Street dealer, they're over there slugging it out. But they're, like I've always said, the dealer that we work with the most, the reason they're doing 25 sales and not 26 is because that's all they can afford, right? They just only have enough capital to do that much business. And so they adjust their underwriting, and their deal structure accordingly. So this whole thing kind of inspired me to look a little deeper into deal structure. And I've been working on some of that already this morning.
You did make a comment about, because it's a compressed affordability window, it's exactly why collectors and customer relationship practices are the most important variables of your portfolio performance.
Relationship practices.
Relationships.
Because you're asking the customer to pay more, and if you don't keep in touch with them, basically, then you can expect a higher failure rate, right? So that's part of what's happening there. So now, kind of moving into how dealers manage their risk, right? So again, this kind of reference, I don't see it here in what I'm looking at, but I think what it referenced was Drive Time, America's Car Mart, and I'm forgetting one, but there were three large dealership groups that it referred to. And so I think a lot of what we can conclude here would say, okay, so they're looking at that segment and calling that buy here, pay here. And while it is, by definition, buy here, pay here, they're doing their own self-financing in-house. They're a much larger, much more sophisticated corporate environment. And so they're the ones who are more likely to have the credit reports, representing the credit data, all that kind of stuff. You're going to have that. But I think that the conclusions that can come from this are still meaningful. So let me kind of dive in. One thing it said here is that a customer paying 25% who doesn't make it 12 months, that's not profitable for the dealer. So it's really, I think I could read into that sentence that when we don't allow the customer, when we don't position the customer to be successful, then we suffer. Potentially our lender suffers, customer suffers, because that deal is not profitable. And we tied up time, resources, energy in doing the deal, and it didn't work out.
What I did appreciate about one of the things that talked about the higher interest rate is the Fed frames this as a legitimate risk pricing mechanism. That the Fed said it's legitimate, that they're doing this. There's a good reason why
they price
they price that way, and I appreciate that, because it was looking at it, this report going to Congress, and that it was unbiased.
Right.
And it's like this, based on the math, And I appreciate that an awful lot. And there were, we'll probably talk about it in a bit, but there were some questions that were posed to NIADA and trying to get some deeper information from some of these committees that are looking at, based on this report and other things that were addressing these kind of things.
Right.
And it was they referenced Jeff Martin and his response.
Yeah, which is good. And it really spoke to a lot of the same things. I wrote an article for Texas years ago about this thing about, I think I call it something about one farm boy's,
with the
imaginary,
the CFPB,
a lunch conversation with the CFPB. Like if I got a few minutes with the CFPB, here's what I would share with them. Right. Yeah. And what I would share, which is really that, when you think about you might look at that rate and think it's predatory, but what you need to really examine is what it costs dealers when they do experience repossession, the cost of the repos.
Yeah.
And so now dealers have also experienced this period, through 24 and 25 now, here we are having this conversation in June of 2026. So those who would hear this later, June of 2026, we're coming off of 2 years of heavy repo losses. We watch in our V8 dealer groups interest coverage, which is the amount of interest dealers collect relative to the amount of net charge-offs they experience in the same period. And we're seeing a lot of dealers be negative in that number for the first time. In other words, their interest, even at the high interest rate, is not covering their losses. Okay, so there could be a lot of factors there. There could be some reasons, and the dealers may bear some responsibility there in their underwriting or whatever, or the way they structure deals. But the reality here is that what it's telling us is that has a correlation to everything else, that we're talking about. And what it also goes on to say is that it talks about deal structure. That and this is a clue to me. It says 14% of BHPH subprime balances or loan balances in the Fed sample are on weekly and biweekly payment schedules. That's an indication that you're dealing with corporate level buy here, pay here, because in Main Street, that would be a much higher number.
The mom and pops.
It's
and
most
number.
Of
the people that we work with through V8 have a biweekly.
You see a lot of biweeklies. Yeah. You don't see as many weeklies now, but certainly you see way more biweeklies than monthlies. And so that number would be a lot higher if they stepped outside the data pool that they were working with. So it's just an example. But I would say when it comes to these interest rates, and the way that they do it, it's like that whole, or not the interest rates, but the deal structure, even the biweekly structure that dealers do. This is Claude's interpretation of what was stated. It says the structure isn't punitive. It's calculated how these customers actually live. So in other words, it's trying to provide a structure that will make it easier for the customer to manage and give them a chance to be successful. It also cited that it helps the dealer's cash flow. Among the reasons that a dealer would do biweekly, and let me just, as a former dealer myself, is like, if a customer is struggling, you might not want to wait until you're 30 days down the line. It's just that kind of time sensitive in our sector. Like if you're 14 days, then you're going to know in a shorter time period you'd rather know within 7 days of a biweekly thing than 37 days of a month.
37 days, your customer's not going to be able to
catch up.
Right. And so it's like, then you're looking at repo, or you're looking at other options that are just really they're not ideal.
Right.
But it can, it's that makes an awful lot of sense, that especially when people are living on that tight of a budget, because we've talked before about was it last week or the week before, the K, and how we can say that the economy is getting better for everybody. It's not for everybody. It is for a sector,
right?
But it is not getting better for the lower angle for the K, and that is our customer and some others.
Sure.
And so it's getting harder for them. So I appreciate, it's like this, it makes sense that it would be a biweekly, not necessarily a monthly payment, because it makes it easier for dealers to be able to mitigate their risks and help their customers get back on track than if it were a monthly. Man, we watch that. That is dangerous.
Right.
Dangerous waters to do a monthly payment and buy here, pay here.
Yeah, it can be.
Mm-hmm.
Yeah, we have dealers who do it successfully, but it's a different animal.
Mm-hmm.
It's something to be aware of. So let me just kind of touch on one point here before we move on. This is kind of things that dealers would know, I think, but for anybody listening who's not deep in the world, it says BHPH loans are 16.6 times more likely to be in active repossession than traditional auto loans.
Mm-hmm.
That's probably not a big surprise to most of our dealer listeners. It says in Q3 2025, approximately 5% of BHPH balances were in active repossession. Compare that to 0.5% for traditional auto loans.
Well, and this is about like the repossessions that's the number that is going to be watched more carefully. And it's the number that will get attention. They're talking about Senator Warren. This is the data point that Senator Warren and the media are going to focus on. Mm-hmm. So buyer payer dealers need to be able to speak to it clearly about the repossession practices and just where their numbers are.
Right. Mm-hmm. Yeah. I see here, I'm cleaning this up while I'm thinking about it. The third dealership that I failed to mention earlier was BuyRider. So it's really, it says match names from regulatory corporate loan data and identified over $2 billion in loan commitments from major banks, including DriveTime, BuyRider, and America's CarMart. Yeah. So they stated that's understated, and they know there's more than that, right?
And so, basically the Fed knows repossessions are going to be high because the risk is high. But we understand and we know that a repossession is bad for everybody.
Right. Sure.
And so, because the customer loses transportation, and it's not just about getting the car back, but it's the expense of getting the car back. And then what are you going to do with the car? And, we hear horror stories all the time about a car, someone skipped payments and they didn't take care of the car and they get it back. And maybe the customer is angry that they know that they're going to get repoed and they trash. It's like, it's an asset that is 100% lost. It's not something they can fix up and put back on the market. It's like, this happens frequently.
Oh, sure.
So, it's, repossessions, it's the cost is a lot more than just the asset.
Oh yeah.
In this industry, it's having to clean it up. It's having to hire someone to go and find it.
The soft costs,
there is a lot that's associated with
it. And Jeff Martin's response to Senator Warren, he referenced a lot of that, which I think is good. It's kind of like what I said about he referenced this idea that
good representative of the industry.
Yeah, and I know that Jeff comes from Texas, and Texas has, at least at the state association level, a high percentage of their members down there are buy here, pay here dealers. So, at the national level, as far as their association members, I don't know, but certainly buy here, pay here is a a significant portion of the membership of all independents. And so he gave a thoughtful and a good response to the senator in asking about that. And I think it's an example of, we're trying, dealers are trying to solve this problem. And obviously some dealers are doing more to help the customer be successful than others.
Yeah. And that's the whole premise of White Hat Way. And when we go around and we talk to different dealers, there are a lot of dealers out there that got into the business for very good reasons.
Oh, of course.
Because they came from that or they've experienced firsthand what it's like to go through having that kind of credit profile and needing a car, and how they make it a point that the transaction is performed with a lot of respect, a lot of understanding, that it's because it is that there's so many dealers out there that there is something close to their heart somehow to this sector. And so they're trying to help them be successful. They're trying to to give them the best opportunity for success, whether it be through their payment, the longevity of how long they're making their payments, or the interest rate.
Yeah.
Or even helping navigate them to a car that might not be all shiny,
Right.
but it will help them be successful.
Yeah. And when you use the word successful, I think this is part of where my work has been, as a former dealer myself and somebody who works with a lot of numbers, and I'll throw in the AI mention, like, this is what's happening. You're seeing it like with me right here, like in recent weeks and months. We're going to help dealers in a way that we haven't been able to help in the past to define success, to be able to know what is, you say, what is successful? Well, I want to be successful. I want to help my customers be successful. I want to have more of my loans work out well. Well, we can better help them understand. And I think this information also kind of supports that, but it's like, we got to learn what it is that we really have to think about. If we begin our business with the end in mind, and I had a great conversation with a dealer last week around this idea that what would it take for you to get a better rate with your lender?
Yes.
Right. And so
that's the big thing, is that so many dealers are out there. If I can shave a percentage, if I can shave off of what their money is, how it will help alleviate some of the stress that they're experiencing. And dealers are like, how do I do this? Well, there's a couple of ways. When you're talking straight line, it's like it's cleaning up, making sure that you've got really, really clean data. In VA, you've been collecting data with the members long enough that it is now becoming a playground in a way for Jim to go, all right, what is the data really showing us? What is it that works? And that's that whole, the report card that we've been talking about too, that it's like, here are there's numbers behind it that are really, really strong.
So let me read something else that this kind of what it calls a surprise finding. Okay. The Fed found that these BHPH credit facilities were actually lower risk. So credit facilities, meaning the lines of credit extended. I touched on this part earlier, but let me read what it actually said. Were actually rated lower risk than loans to traditional auto dealers by the banks themselves. Okay. Because banks built in structural protections, over collateralization, low advance rates, right? Loan guarantees, special purpose entities that made the loan safer despite the underlying customer risk. So it's not all bad news here, but you have to ask yourself, of those banks who did have more favorable experiences in the buy here, pay here segment, are they, because this part that varies, they shrink and contract. This is the thing I've seen is all the years I've been in the business, I've seen money expand and contract, access to capital, Wall Street, all of it. Like it comes and goes in this segment.
Almost 30 years.
You see some ebbs and flows. And what we're seeing right now is going to be a tightening. And I think the reason we're bringing this conversation now is there are some real good clues in this report that are going to give all of us a better idea. What is it going to take for me to, one, get access to a line of credit so I can grow my business, and two, have a favorable rate that doesn't just strangle me and my business, right? So that's the part that we want to watch. So that was all working well, but the whole Tricolor thing really kind of broke some things, and it caused everybody to recoil and say, we better have a closer look at this, because this is, and that's a really uncommon thing. But when you have two big banks get stung for big dollars, it naturally is going to have a ripple effect. And we've covered that before, but this study just really digs in and says, this is what we see about how dealers operate in that segment, right?
I again, Claude and ChatGPT, they're familiar with our entire library of podcasts and other things, and it said the Fed spent months studying buy here, pay here, and essentially produced a document that validates what White Hat Way has been teaching for 25 years. This is a high risk model that serves a real need, and the operators who manage it with integrity, with structure, and with relationship first principles outperform those that don't. This is basically AI looking at this this whole study, and it's like, yes.
Yeah, you're right. There's another statement here that's kind of the same thing. It says dealers who will maintain and grow their capital access are the ones who can demonstrate clean books, transparent reporting, legitimate collateral management, and a values-based operations framework. So values is a key word in there. And I think, it's a little like, I used to say this, and I think I said it in that article, like, it wouldn't be too hard for me. If I were an examiner, it wouldn't take me long to get inside an operation and see the difference between predatory or not. I'm just telling you, it's a pretty clear line in my mind, and it would be for a regulator. I'm not saying that a regulator is showing up at anybody's door tomorrow, but I think there's a pretty clear way to tell whether, pick a buy here, pay here operation. Are they being predatory or not? Right? And we can save that for another day, but I think it's pretty easy to spot. So I think we want to make sure, because we know that's really what they're targeting is predatory. They're not targeting the buy here, pay here segment. I think the senators who took a moment to read this report would say, okay, they need to be there. They serve an important purpose. And there are some that are probably being predatory in that segment. I think that's the other conclusion. So I think it creates an opportunity for those going forward. And this is what I say, for the dealers who will be there in 6 months and 6 years. I think what this is starting to paint a picture of is who will be standing, who are the most likely dealers to be still standing in tomorrow's buy here, pay here, subprime financing segment. And I think this is why this story becomes important. So we encourage people to go, read the entire report, make sure you know kind of what's there and what's relevant. Again, for our Main Street dealers, we don't think anybody's knocking on your door necessarily looking for, to look into your books. We do think, though, that this provides a clue that helps how can I run my operation today, tomorrow, next week in a way that positions me to make sure that I'm not in that group who is ultra scrutinized. If you take a minute to scrutinize my operation, you're going to see that we run a clean operation. We want to see our customers be successful. And now you're going to have better access to capital. And so, like I say, go ahead.
It shows to me too, through all of this, how important it is for a dealer to understand their numbers.
Yeah.
It's not just because that's part of that transparency. And when you're talking about banking, they want to know. They want to know in a very clear picture what your business model has done,
right? And
whether or not it's a good risk. And it's alarming at times when we work with dealers that don't know their numbers,
right,
and aren't willing to learn. And it's like the only thing they're doing is looking at, well, my bank account balance, and I can pay my bills every month, and I can pay myself, and I can help my kid in college, so I'm good. It's like, oh,
right. Yeah, for sure.
Yeah. So,
well, and that just leads me to one thing we can mention in closing is that we want to see dealers join our V8 dealer groups. The month of June here will be the second time that dealers have seen their report card. And we're starting to really analyze business models side by side. And so I think this is a clue that's going to allow dealers to go beyond this idea that I like my model for these reasons.
Yeah.
And I'm going to be asking dealers, why do we like that model? Why have you chosen to do this cost of car? And sometimes it'll be limited by capital or whatever, as we said. But I really want to hear from them, because now as we start to see the letter grades and see, dealers lined up against one another in terms of their business model, now we get to ask and say, well, you like your business model, but you're not banking as much money as the dealer next to you. So let's talk about that.
So go to whitehatway.com, and there's a V8 page there. Right. There's a get more information from there if you just want to be able to kind of look yourself. If you want to actually have a conversation with Jim, call or text 903-816-0216. We can give you some information about that. And it's never too late within a month, because you can get in and then participate in observe. before you actually are able to plug your numbers in and then see where they compare. And really, really valuable. We've gotten some really great feedback about how powerful that grading system
meaningful.
is.
Yeah, it's meaningful. And some dealers are going to be uncomfortable, and I think that's a good thing. I think it's good to have some analysis on that. We're tweaking the calculations in terms of what it does to make sure that it kind of allows for all the elements that are part of a business model. But yeah, the first read was pretty relevant data, and it's really important to the organization. So come be a part.
Good conversation. It's Friday. It's the summer. It's kind of cloudy here. So I don't know. We're not going to spend time out in the sun. Enjoy your day, everybody. We're really glad that you joined us. Those of you who are heading to Denver next week for the national conference, have a great conference.
What a great make sure before we close up, we've got Hugo Sanchez expected to join us next week. We may have to pre-record on that. Hugo will be in touch about that, but we have Hugo coming. Yeah, that's right. Michelle's birthday's coming up. She's going to be Friday, 29 again.
And I was like, honey,
yeah.
So. All right, everybody. Again, thank you so much, and have yourselves a great weekend. We appreciate you joining us.